Biggest driver of markets for us is still monetary policy, and the reality as to whether we see central bank divergence become reality. And then the second thing is going to be how do corporates react in terms of some of the earnings growth that we're seeing fade as we move into the end of 2015. We're going to need that if we're going to see equity markets perform in 2016. The global economy is very mixed. We're clearly seeing a lot of weakness in emerging markets, partly driven by the slowdown in China. And in the developed world, that is impacting manufacturing, which has been verging on recession. But on the good side is we're seeing very positive numbers in the service economy, and the consumer still seems to be able to put money into the global economy. So one of the big phrases that's been used recently is this bad news is good for markets, and it really refers to this idea that we're very wedded to central bank liquidity. And if the economy generates significant good news, then potentially they'll take that away quicker than markets are ready for. So we've ended this area where we want bad news, which is good for markets if it doesn't remove liquidity from central banks, as long as it's not too bad. So one of the biggest drivers of US equity markets the last couple of years has been companies buying their own stock. And arguably with earnings growth starting to drop off, with leverage already increasing, they won't necessarily be able to continue to do that. But it does mean that we might see other countries take up the baton, one of them being Japan, where we've seen a lot of changes in corporate governance, and even possibly here in Europe.